Something is happening in the American economy that almost nobody is prepared for. Inflation is cooling, but prices aren't going down. Debt is at record highs, homeownership is collapsing, and a massive wave of layoffs is quietly starting. So if you think things are normalizing, then you're in for a brutal wake-up call. This is the first time in a while where I've kind of looked around and been like, oh shit, I actually feel uncomfortable about the American economy. Like, don't get me wrong, I graduated college during COVID in 2020, but I've never seen a really big crash in the US economy like people saw in 2008 or in the dot-com bubble back in the early 2000s. So what is actually happening in the US economy? Well, the first thing is that prices aren't going up, but they're staying up. So inflation is cooling down. It's not very high the way it was back in 2022, but prices are still going up year over year. It doesn't mean that prices are falling and going back to 2022 levels or 2021 levels. We're still seeing the price of everything go up. I mean, groceries are up 25% compared to 2019. Rent is up 20 to 30% nationally in the same period, but then wages are only up 15%. So the cost of everything is going up, yet our wages aren't going up to account for that. So even with lower inflation that we've seen the past couple of years, people feel broke because the price increases have already happened. So prices are staying up. They have not cooled down at all. The middle class, I feel like, is getting completely squeezed. Like, the median American can't afford the median home. 30-year mortgage payments are 2.5 times higher than 2019 for the same house. And the main reason for that is because interest rates are so high right now. And the only way for interest rates to continually keep getting cut is if inflation keeps dropping, which so far it has. And we have seen, I think, 2 cuts so far this year, but we're going to need to see the interest rates come down for people to be able to afford housing again, because prices aren't dropping, yet interest rates have gone up quite a bit over the past few years. The average rate right now for a 30-year mortgage is somewhere between, I'd say, 6 and 7% from what I've seen, and the home ownership rate for young people is dropping. I saw something recently that said the median age for somebody that is a first-time home buyer is 40 years old, which is the highest that we've ever seen. Even compared to just a few years ago, I think it was like 33 or 35, maybe 37, somewhere around there, but now it's jumped up all the way to 40. If you go back into like the 90s and the early 2000s, it was a lot younger. I think it was like early 30s or maybe late 20s even. Don't quote me on that, but I do remember seeing that. I'll try to find a screenshot for it to back it up there. So the middle class is getting squeezed, and the main point I was kind of making there is that the median American that is making 45 grand a year, they definitely cannot afford the median home price. It would take years of saving and being very smart financially to get there. The next thing that is very alarming is that debt levels are exploding. So total household debt is now over $17.5 trillion. We have credit card balances at record highs, and auto loan delinquencies are at a 20-year high. So people are going delinquent on their car payments. Credit card balances are just at record highs. Total household debt is at a record high, and many Americans are financially fragile right now. And even a small downturn, even a small emergency of $500 or $1,000 could completely break them. So prices are staying up, the middle class is getting squeezed, and debt levels are at all-time highs. And not only that, but it feels like layoffs are quietly increasing. I've been hearing about a lot of companies that are doing layoffs over the past 2 or 3 months. I even saw something that said job cuts in October hit highest level for the month in 22 years since 2003. And this has been the worst year for layoffs since 2009, which should be extremely alarming to people. If you have a job and you are safe in your job right now, be very thankful, because it seems like things are going pretty bad. I'm not saying for everybody, I'm not saying for every company or every industry, but for a lot of them, I'm seeing a lot of stuff that is pretty alarming, I would say. Especially in regards to tech companies, it seems like they are laying off people by the tens of thousands. I think Amazon laid off like around 14,000 people, or about 4% of their workforce in October, as well as another one I can think of off the top of my head, Verizon is laying off, I think, about 15,000 people. So we're seeing some pretty sizable layoffs here. This isn't just like 1,000 people at a massive company. This is like, 10,000 plus people at these really large companies. So it is impacting a ton of people. So why this feels like a crisis is because people are feeling higher prices, they're feeling higher debt, they're having slower wage growth, so they're probably tapping into more debt because of that. And the worst part is when you go to borrow and use that debt, you are now in a higher interest rate environment, and there's less job security. So this is why this stuff feels like a crisis. I mean, it's pretty alarming. Now, do not get me wrong. I'm not just here to fearmonger you guys. I do believe that there are some things we can be doing to protect ourselves, and I'll talk about that at the end of this video. So that is where the US economy is at as of right now, but I also think that this is going to turn into a bigger financial crisis. Now, I'm normally not the type of person to try to sit here and predict where the economy is going to go, because at the end of the day, this channel is about building wealth and doing well for yourself long term. And I follow 2 very simple rules here. Live within your means, and then any leftover money that you have, invest as much as possible, as consistently as possible. But when I look around, I look at the job market, and I look at, like I said, the amount of debt people have, the total cost of things, wage growth, all of these things, it is pretty alarming. So I do think this could turn into something pretty bad. Again, not sure, but this is just my prediction. Part of the reason I think this could turn into a financial crisis is because we have high prices plus high interest rates, which that is just painful. That is a brutal environment to be in. And the reason that we have high interest rates is because the Fed raised rates aggressively to fight inflation. This was like back in 2022. We saw year over year inflation hitting just record highs. And part of the reason we saw so much inflation was because the amount of printing of money that happened in 2020 during the COVID crash. So basically what was happening in 2020 as well as 2021 is that the Fed cut rates, which then increases borrowing and spending. They cut rates because they knew that they needed to stimulate the economy because of COVID. They also gave out those stimulus checks. They were printing money like nobody's business. And then 2022 happens. We see a lot of inflation. The Fed then now has to go cut rates to lower the rate of inflation over time, which we have seen. Inflation has gone down, but year over year, inflation's still going up. Like you're still seeing prices go up 3% year over year or 4%, which is not as bad as 9%, but it's still year over year growth. We are still seeing prices go up. So because we're in a high interest rate environment, that means that borrowing is now more expensive. So that goes for credit cards, mortgages, car loans, anything that you are going to use debt for, it all costs more money because interest rates are higher. And the thing that is so brutal about this is that Americans kind of got hooked on cheap money. And what I mean by this is from 2008 to 2021, the Fed had very low interest rates. It was very easy to get loans. We had stimulus money back in 2020, as well as the stock market and the crypto markets just absolutely pumping over the past 10 to 15 years. And people, I feel like, got used to winning financially without trying. Now, I'm not saying that, 2008 wasn't bad because it absolutely was. Like that was a brutal recession that we saw. But the era of low interest rates and stimulus money and that sort of thing, I don't know if we're going to see that again. Hopefully we could see low rates again, but we'll just have to see how that turns out. It seems like that era is over. So people were addicted to cheap money. The next reason I think this could turn into a financial crisis is because companies are cutting back pretty heavily. Because there are higher rates, that means that there is less borrowing. Because if a company wants to go borrow, let's say $1 billion, and they have to pay a higher interest rate for it, they're less incentivized to because of these higher rates. And so because the cost of debt is higher, what we are going to see from a lot of companies is they still want to do good on their earnings. They still want to impress Wall Street. So they need to cut expenses and increase revenue as much as possible. And one easy way to cut expenses is to have a lot less hiring, as well as having more layoffs. And I actually work at a Fortune 500 company, and we are cutting jobs very heavily. This is a very common thing, it seems like, across the board. And a lot of companies are lowering their investment amounts. Don't get me wrong, some are doing really well and they're going up, but it seems like besides the Mag 7 companies, a lot of, just huge US companies are not doing that good. So we are seeing a lot slower business growth. And like I said before, we saw a ton of job cuts in October, which is pretty alarming. I really hope that, the economy can bounce back. We will have to see here, but also housing is just completely out of sync. And I've even talked about that in a couple of videos now. We have people who are locked into 2 to 3% mortgage rates, and they're not going to sell their house because why would they go sell their house for $500,000 at, let's say a 3% interest rate and go transition to a $700,000 house with a 6% interest rate? I mean, that monthly payment would be so much higher. Nobody wants to do that, and I completely understand why. So you have a group of people that are locked in at these really low rates that they got back in 2021. They're not going to sell because they don't want to have to go buy back in that same market. One thing I still don't really understand is it seems like the housing inventory has just stayed low. Like, I don't know why they are not building more homes, or I feel like there should be incentives to build more homes. That way the supply of housing would increase, which would hopefully lower prices over time, or at least make things a little bit more affordable while rates are still high. But we haven't really seen that so far. It seems like prices are staying high. And so this is just crushing people like Gen Z who are, first-time home buyers. So all these different things are happening, but also the government is just drowning in debt. The US national debt right now is over $34 trillion. Interest alone is $1 trillion per year, and that's more than what we spend on the military. And so the hard choices here from the government's perspective is they have to either raise taxes, print more money, or cut services, and each option makes life harder for normal people. I feel like part of this crisis that's going on is people just don't have confidence in the United States right now. We don't trust the economy. We don't trust the housing market. We definitely do not trust politicians. The stock market's getting propped up by 7 companies. And so when confidence drops, we will see behavior change. Spending will change. Investing will slow down and the economy will stall. So what could happen next? And I'm not trying to sit here and paint this, brutal doomsday thing. I'm just trying to talk about a couple of realistic scenarios so that we can be prepared. So the first scenario I could see happening is we just have a slow, kind of just a brutal, slow burn recession where it's not a crash where, things tank over, a month or two. It'll take a long time. Things will slowly drop. It's just a long period of struggle. You have flat wages, you have higher prices, so more people are falling behind. The next thing that I think could happen is we see higher unemployment. Companies are continuing to try to cut costs, and the easiest way to do that is to lower headcount. And that basically just means not backfilling any positions, not not hiring for any new roles, and also just trying to fire and lay off people where you can so that you can cut expenses there. And the people that are going to feel this the most are people coming out of college, people who are entry level or even out of high school, just younger workers. They're going to feel that pain first because a lot of companies are going to be cutting some of those lower end jobs. Again, this could happen in any part of the company, but I do feel like entry level workers will definitely feel that hit pretty bad. I've even talked to quite a few people that are a little bit younger than me. I'm 27, and I've talked to a couple people that are, 23, 24, 25, and they're all saying that the job market right now is just atrocious. So I'm definitely sorry to hear that if you guys are struggling with this right now, because it is very hard to endure a rough job market. And so going off of that, the next thing that could happen is that we could just see a housing freeze where we have very few buyers, very few sellers, and there's just basically a stalemate. Nothing really happens until rates start dropping more. So that's another thing that can happen. And on top of that, we could just see interest rates stay higher for a longer period than people expect. If inflation does not continually drop, then the Fed might end up seeing another 1970s situation, and they want to avoid that at all costs. They do not want to see mass inflation like what we saw, I believe it was in the late 70s with Jimmy Carter. And so the Fed is going to try to avoid that as much as possible. So we really need to see inflation continually dropping here. That way the Fed can then turn around and cut rates, which will help a lot of people. And then the last thing, and we're already starting to see this a little bit, is that markets are becoming a little bit more volatile. It seems like one day the markets are super green, the next day they're very red. The past couple of weeks or so, past month, I have started to see that a lot more, which for me, I'm not panicking at all because I'm a disciplined investor, and anybody that watches this channel, I really hope that you are too. If you are not, watch some of my videos. I'm telling you guys, they will help a lot when it comes to investing and really building wealth long term. But if you're an emotional investor and the markets are volatile, you're having a bad week, you're having a bad month, you're really struggling because the market's just all over the place right now. So if you got this far in the video, thank you for still watching. Now let's actually talk about how do you protect yourself. Let's talk about what you can do to really set yourself up so that you are not getting just destroyed in this economy, especially if it gets worse. I want you to put yourself into a position where you can thrive and do well. So the first thing that you can do is start by trying to strengthen your own personal balance sheet. What I mean by this is get rid of any high interest debt, start building a small emergency fund, even if it's just $500 or $1,000, whatever that looks like for you, this will definitely help. And the next thing you got to do is avoid lifestyle creep. This destroys everybody, especially young people, when your income starts to go up over time. I can make an entire video talking about lifestyle creep, but basically what I'm saying is if you get a promotion or if you start to make more money, do not spend more money. Try to keep your expenses as flat as possible and make sure that you're living within your means. So that's the first thing you can do. The second thing you can do is try to become layoff proof. What I mean by this is build skills that companies cannot easily replace. Focus on skills that are either cutting costs or they're revenue generating, or there's something that you're doing on your team of people that nobody else can do and you can't be replaced easily. But also make sure that you're keeping your resume updated, keep your LinkedIn active, try to build a network before you need to lean on that network. That is definitely important. So really try to focus in on what skills you can do that are extremely valuable to the company that couldn't be replaced. Or even if they did try to bring in somebody to replace you, it would take them a while to pick it up. Try to be as valuable as possible. The third thing I would say is use volatility to your advantage. The wealthy people do this and the middle class does not. When the market goes down, that means you buy more. When the market goes up, you ride the wave up and you keep buying. And so keep things very simple. Diversify your investments. Just buy VU or VTI or SCHD. Just invest into index funds. I like VU the most. That is what I put all of my money into, and I dollar cost average, which definitely beats emotional investing. And all I'm saying when I'm saying dollar cost averaging is I just invest every 2 weeks when I get paid. It's really that simple for me. So you can absolutely use volatility to your advantage. I might even make an entire video talking about this if we start to see the stock market tank more. So far, it's only down about 4% from the high, so really not much of a sell-off at all. But that's the third thing you can do. The next thing you could do is try to increase your income, and this is the most important part. A lot of people stay broke because they focus so much on expenses, but I feel like winners long-term focus on income. So there's a couple of ways to grow your income. The first one, and I know this is maybe not realistic, but sometimes it is for people, is just ask for a raise. Show data and show proof of all the different things you're doing and working on and the value that you're providing to the company, and try to ask for a raise, or maybe just get a little bit larger raise than what you're already going to get if you can. It never hurts to ask. The worst thing they could say is no, and you're still just going to get the same raise you were going to get before. The next thing that you can do to grow your income, and I know this is hard right now with the current job market, but if you can pull this off, it could definitely work, and that is to switch jobs every 1 to 3 years for higher pay. This is 100% the way that I grew my income a lot, was just by switching jobs every couple years, because at the end of the day, the new company you're interviewing for, they don't know how much money you make. You can negotiate your salary a lot easier with them because they don't know where you're already at. Compared to when you get promoted, they know exactly where you are and they know where they're going to put you. Compared to when you get promoted, they know exactly what your salary and your bonuses and all that stuff, and they know exactly where they're going to put you afterwards, like how much you're going to increase by. Compared to when you go to a new company, they don't know any of this stuff. So you have the advantage and the leverage on your side. So switching jobs definitely works, but again, I know the job market is brutal. That is so much easier said than done. And like I said, a ton of companies are laying off right now. So you do want to make sure that you're getting hired with a company that has pretty good job security. The next way to grow your income is to try to start a skill-based side hustle. So whether that is some hobby that you have, whether it's, I don't know, photography or woodworking, or something you could do to maybe sell yourself, whether it's a product or a service, something that you can do to just make a little bit of money on the side, that will always help you. Or if you don't want to do the side hustle, you could also just try to learn something that increases your hourly rate. There are a lot of companies and a lot of jobs where if you get certain certifications or, you get certain things done or you learn new skills, that this will actually increase your hourly rate and you can then make more money, which is always really nice. So overall, what you want to do is try to build a recession-proof life plan. Live below your means during the good years, stack cash when things feel easy, definitely have that emergency fund ready to go for when you need it, invest automatically, try to make it as simple as possible, and don't make big emotional decisions when the economy is unstable. Try to stay calm. At the end of the day, you got to look long term. Don't even be thinking about 2025. Think about how you can get to where you want to be by 2028 or 2029, even 2030 if you need to. Because every economic downturn in US history has eventually led to higher markets, higher wages, and more innovation. And downturn creates opportunity. This is where the future millionaires are going to be quietly built. And so, yes, I do think America is entering a financial crisis. I don't know when this will actually happen, but I'm already feeling like I'm starting to see it. But this doesn't mean that we're all in danger. There are definitely opportunities and turning points, and there are moments where people who stay disciplined leap ahead of everybody else who panicked. And do not fear what is coming, just try to be prepared for it. Again, I could be wrong about all of this, but this is just what I'm seeing, and I do think if you are prepared and you are ready ahead of time, it is going to make this a lot smoother for you. So I hope you guys enjoyed this video. If you did, drop a like down below, hit that subscribe button. I'll see you in the next one. Peace.